Coming up in this episode, does Bitcoin really move with the Nasdaq, or is that just a market myth? We dive into the data. Meanwhile, people are panicking about the falling dollar, but is it really collapsing or just returning to normal levels? We also look at the IMF's latest downgrade and whether their gloomy forecasts actually mean anything. Despite all the noise about tariffs and supply chain chaos, AI spending keeps roaring ahead, and we'll show you why. Plus, in our educational topic, we break down how bond ratings work and why blindly trusting them could be a big mistake. Stick around, we're cutting through the noise and getting straight to the real story. Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Rob Ferrian. He's the CEO and founder of Flying V, our digital marketing partner, and about to run to catch a plane. Rob, what's going on with you?
Yeah, Gary, thanks so much. Really excited to be here. Just doing some of the intros that we work on and work into the clips prior to the show. I'm really excited about the topics that we're talking about today. I think they're all really exciting. But I'm actually heading to Miami. Red eye into Miami tomorrow morning, full day of work. And then Wednesday, actually going to be out there at an investors mobility summit. Really focused EV automotive space. We've got some products that are portfolio companies of ours that we're building network connections with or for. So yeah, really excited to be down there. Went to an event last year. We were just talking about it before we were on. That was in the White Plains area. But yeah, put on by my good friend, Sam Baker. He runs Mobility VC. He's based out of Southern California here, but they operate globally as well. Some members, Sean from Hong Kong, he was telling me about his travel and what it's going to take him to get to Miami. But yeah, we work with him on a regular basis. And then I know he's got a team on the East Coast and then Portugal. That's where Bruno from Mobility is situated. So yeah, really excited to be there with that group. And we got our whole team, Brennan, our chief revenue officer, my brother, chief financial officer, and then an investor partner of ours that we work with will be along with us. So yeah, it should be a lot of fun.
All right. Well, looking forward to seeing the photos from a fun week in Miami.
Yeah, we'll definitely get some of those going on LinkedIn. Maybe run them through a filter. Make sure Miami's going to be a fun time. So yeah, we're excited and should be a lot of fun. So if anybody's out in that area, let me know. We'll be out and about. So, but yeah, really excited for this week's issue of the 5 things. We're calling it the correlation issue. Gary, we're talking Bitcoin. Really excited to hear what we have to say about this correlation data with the Nasdaq. We're talking about the dollar, IMF, F as in Frank, AI, and AI spending makes another appearance. And then for our educational topic, we're talking about the understanding of bond ratings. So be sure to check that out at the end of the episode. Gary, getting right into it. We're talking about investor claims about Bitcoin and its correlation with the Nasdaq, right? I think if you look at some charts, you can definitely see correlation trends, even kind of mapping it one over the other. But what we want to talk about today, is that actually supported with evidence? We've looked into it, which is awesome. Thing number 1, Gary, is Bitcoin really correlated with the Nasdaq?
So, Rob, for the past few years, investors have claimed that Bitcoin trades with the Nasdaq, and I'm guilty too. On multiple occasions, I have said that Bitcoin is traded as a high beta proxy for the Nasdaq. Okay, we're going to explain that. That's just a fancy way of saying that when the Nasdaq rises, that the Nasdaq is an equity index that has a lot of technology exposure. So all we're saying is that when the Nasdaq rises, Bitcoin tends to rise more. And when the Nasdaq falls, Bitcoin tends to fall by more. So that's what it means to say Bitcoin is a high beta proxy for the Nasdaq. And so what we've thought was happening was when the market was going risk on, And that's sort of those are the FOMO moments, the fear of missing out, when everybody says, "Oh no, we're going to miss this great market run, and we're going to buy, all kinds of high multiple technology stocks, and Bitcoin and all kinds of other crypto." Those are the moments when all of those indexes and Bitcoin and crypto, they all move up together. Now, other people have suggested that gold should be negatively correlated. And what they're insisting is that when the market goes risk off, so those are the moments when everyone says, "Oh crap, everything's falling apart. I want to get out." Right. And everybody tries to get out together, and money flows out of those same high multiple tech stocks. A lot of those funds will find their way to the safe haven of gold. So the stories seem to make sense, right? I mean, it's what we've seen, and the story that I just told kind of makes sense. So, that's why people are saying it.
So, Gary, what would you say then is the actual correlation of these assets? Is there anything to it? Is it just broad, rising tide floats all ships type of analogy, or what are we actually looking at in terms of the correlation of assets?
So, Rob, again, I'm going to acknowledge that I thought those correlations existed. And until you look at the data, you can't be sure. So, DKI intern Cash and Crow and I, we pulled the data. We pulled weekly price data
This
on
fires me up,
Bitcoin.
by the way.
What's that?
I said this fires me up walking through this, by the way.
Why is that?
Just it's exciting, yeah, what we've put
Yeah.
together to correlate this
Yeah,
out.
exactly. I mean, everybody says this, and the story makes sense. When you tell the story, it all holds together. So, the question is it true? And so, Cashin and I pulled weekly data on the Nasdaq, on gold, and on Bitcoin since the birth of Bitcoin back in 2011. So we've got a lot of data in here. And you ready for this? So, charting the weekly prices since the inception of Bitcoin, we have a correlation of 0.0% with the NASDAQ. Zero correlation. Now, if people are saying, if they want to say, well, of course, Bitcoin is rocketed and, the NASDAQ's gone up and down. And, of course, okay, great. So we also ran annual correlations. And the highest correlation that we saw on the annual correlations with Bitcoin was in 2014 at 11.5%. Just so you
Wow.
know, to say there's a strong relationship, you're looking for something more than 70 or 80%. 11.5% is not zero, but from a statistical point of view, it might as well be. The point here is, and by the way, that was the one spike. Yearly correlations are almost all below 4%. Again, that's a rounding error of zero. It's a minimal level of correlation. And it's also true. The thing that surprised me, it's true despite the fact that both Bitcoin and the NASDAQ stocks both benefit from higher worldwide liquidity. Now, we would have thought that gold would be negative correlated with the NASDAQ. And it turns out when you look at the data, that's not true either. That 15-year chart shows a correlation. Ready for this one? 0.2%. So 1/5 of 1% with an annual high of 10.1%. Again, to say there's a real correlation, you're looking for something 70, 80% or more. So a lot of people are claiming that alternative assets in general and Bitcoin in particular do not provide portfolio diversification. It turns out the long-term data tells a different story. And DKI uses Bitcoin and gold as a way to ensure against long-term dollar debasement. You know, People will see on the occasional day, the NASDAQ will be up 1%, Bitcoin will be up 2%, and they'll say, see. But again, you noticing an observation is not the same as a decade and a half of data.
Gary, you've been talking about it for years, dollar debasement and DKI's positioning to protect against that with positions like Bitcoin and gold, which perfectly segues us into thing number two, Gary. We're seeing investors claiming that the dollar is falling. You're saying, hey, whether or not that's true kind of depends on what point of view you're taking, like most things, and what your time frame also looks like. Gary, thing number two, we're going to get right into it. The dollar is falling, sort of, you're saying.
All right. So first, Rob, let's make a clear delineation here, because one of the things that we've been talking about on the show for a couple of years now is there are two ways to view the dollar. If you are a foreign exchange trader, you look at DXY, or people call it Dixie, and that is an index of how the dollar trades against other major currencies, such as the euro, the yen, the British pound, things like that. Now, if you are a US citizen and you want to do things like buy groceries, or, fill up your car, or buy a car, or pay your rent, what everybody's noticed over the last, half decade or so is that prices have gone up a lot. And another way to say that is the purchasing power of the dollar has declined. So right now, we're going to put aside the fact that our dollars are all losing purchasing power, something we've talked about a lot, and actually talk about the dollar as a foreign exchange trader might look at it. So we're going to look at Dixie, DXY. And so there's been a lot of talk in the press lately and on FinX about the plummeting dollar. And so, whether that's true or not really depends on your point of view. The index has fallen when we were writing this last week to 99 from its January peak of 110. So, we're talking about a 10% decline over a period of 3 months, and currencies tend to have small percentage moves. So, a 10% decline in a few months is significant. But, the question here is at the end of the story.
Yeah, Gary, with all the people claiming that the dollar is, or the people that are claiming that the dollar is down, are they wrong? And then also, I mean, what really is the point of all of this, right? What does it tell you? How are you using this to position yourself in the market?
All right. So let's take those two questions. Those are the right questions, Rob. Let's take them one at a time. The first one is, like, are they wrong? No, they're not wrong, but they're looking really short term. So a 10% decline in 3 months is significant, and people are responding to that. But if you take a look at the written version of the five things, we have a chart that goes back 30 years. And when you take a look over a 30-year period, you see something very, very different. So DXY, or Dixie, traded at the 99 level or below that in 2022, 2020, 2019, 2017, 2016, 2015, 2003, as well as many other years. During much of the time between 2003 and 2015, Dixie not only traded well below the 99 level, it traded even below the 75 level. So, if you're looking at a really short term graph, it looks like the dollar is plummeted. If you look at a long term graph, this is completely normal. And actually, the dollar is well above its 30-year average. So, these things tend to even out over time. And I think it's really important to take a look not only just at the short term view, but the longer term view. Now, the question you're asking, the second one, Rob, is really, is there a plan for this? Does this matter? How did we end up here? And the truth is, right now, President Trump is very focused on reducing our trade deficit. And we also need to do something about our enormous debt. And so the only way we're going to be able to address that is with a weaker dollar. And the whole point of this is a weaker dollar makes imports more expensive, so less attractive, and exports cheaper for our trading partners. The US products that are being exported to them will to them look cheaper. So, one of the things we've talked about before is that most Americans are not foreign currency traders, and experiencing a weakening dollar each year measured by its declining purchasing power. And we're going to be facing inflation. And that's the only way we're going to get the trade deficit down, and the only way that we're going to be able to deal with the huge amount of debt that we have. So I think this is going to be uncomfortable, but it is part of the plan.
Yeah, that's great stuff, Gary, there. And I think just in general, right, understanding, okay, what is the perspective that you're looking at something, whatever it might be, right? Whether it's data, specific scenario, life situation that you may be in, whatever it is, right? It all depends. What's the perspective? What period of time, right? Through what lens am I looking at things in regards to the situation or the information? This is this week's version of the five things. We're calling it the correlation issue. Be sure to head to deepknowledgeinvesting.com if you have not already. sign up for a free subscription. You'll be added to our mailing list to ensure that you get every written version of the 5 things, as well as notified when we do post new content to the website. As a free subscriber, there may be content that's gated or paywalled for our premium subscribers who get full access to the entire website, as well as information on current recommendations for the DKI portfolio. And most importantly, when initiating positions and critically exiting positions, more importantly than anything. Moving on, thing number 3, we're talking the IMF. They slashed forecasts. Does it matter? Well, I actually just read thing number 3 with my intro segment. But Gary, thing number 3, the IMF slashed forecast. Does it matter? Let's say it twice just for emphasis.
Exactly. So, Rob, here's the interesting story on this one from my point of view. I was working with DK intern Cash and Crow this week, and he pitched this story and he said, "Hey, look, the IMF, the International Monetary Fund, they downgraded global GDP growth for this year to 2.8% from its original 3.5%. So, it's 0.7%. That's actually a meaningful number when we're talking about something as large as the global economy." And so we said, this is pretty interesting. What do you think? Should we put it in the 5 things? And, my first reaction was, well, who cares what these guys say? Like, nobody's accurate. Like, great, they're making projections, but who cares? Why does this even matter? And then I stopped to myself and, again, this is the correlation issue. And I said to Cashin, you know what? Let's check the data. Let's take a look and see, is the IMF accurate? And so Cashin pulled the data going back for a full decade. And it actually turns out the IMF's global growth forecasts are super accurate. They were wrong in 2 years. One was in 2018, where the actual was much better than the expected. And then they were really wrong in 2020, understandably, when, with COVID, everybody was off that year. So with the exception of 1 year where they missed and 1 year where everybody missed and, nobody was predicting, the economy to stop, they've nailed it. Every other year, I mean, these guys are within a fraction of a percent, and in some years the dots actually overlap. So, what I can tell you is if the IMF is saying we're taking down global growth predictions, that is really hard to say. It's probably something to be taken seriously, and there's no doubt about why. They're very concerned about tariffs, and they're worried that, President Trump's tariffs will bring global trade to a slowdown or a halt. Now, again, the White House is in negotiations right now with at least 70 different countries, and they're claiming they'll have deals done soon. But, until it's done, it's not done. And the real question is going to remain, what's going to happen between the 2 largest economies in the world? How much trade is going to take place between the US and China? And, even over the weekend, nobody could decide, nobody could agree on whether they were talking or not. The US was claiming we're talking to China. China is claiming, no, we're not in discussion. So, the IMF may be right or wrong on this one, but it's pretty easy to see where they're coming up with their numbers. And I actually find their analysis to be credible here.
Yeah, a lot of cat and mouse going on, obviously, with everything with the tariff situation, Gary. With that being said, I mean, even with their forecasts, not a huge decrease in expected growth either way. So again, I mean, yeah, how big of a deal? How much, how much do we put into this, or what do we make of it in terms of its magnitude?
So, look, for the whole world, it's easy to say, hey, it's less than 1%. How much does it matter? But, again, against the world economy, it adds up to a lot of dollars or a lot of yen or a lot of won. It's the world cares about this stuff. Looking domestically, President Trump is using these tariffs in an effort to reverse years, decades of import dependence. And, the IMF and US economists are correctly saying, hey, we're worried that this dependency might hurt growth in the short run. And so, while I find that prediction to be credible, here's my question for everybody else. The US has been selling off its manufacturing capacity and outsourcing more and more to cheap overseas markets for approximately 50 years. It's been half a century. So if we want to reverse 5 decades of selling off our manufacturing capacity, I think we have to understand that we're going to take some pain up front. It's going to be uncomfortable. President Trump, to his credit, has been forthcoming about that. He's it on this issue. He's been a little different from most politicians. Most politicians will tell you, yeah, we're going to give you guns and butter and candy and everything you want. And don't worry, nothing costs anything. It's all free, right? That's sort of what all politicians will say. To his credit, President Trump has said, yeah, look, the market is going to take a hit. There's going to be some pain. In the meantime, we'll get through it. And I think that's a really good take. And I think it is going to be uncomfortable, and reversing half a century of these outflows of outsourcing all of our manufacturing. Of course that's going to hurt, but it either we do something about it, either we take that pain, or we just become a country that exports financial services in dollars. And that's probably not a good place for the country to be. At least it's not a good place for most of the country to be, right? Like that'll work for me, right? I can make that work, but most of the country is not, living in the New York area focused on finance. And so if we want an economy that's going to work for, more than 300 million people, we're going to have to do something about it.
Yeah, great stuff. I call it in my line of business, actually correlating it there with the correlation issue, the slingshot effect, right? So, and what I mean by that, slingshot, right? You got to go back before you go forward. And so, a lot of times when we're working with clients and we're coming in and we're adjusting certain things that have been set in a certain way for so long, you actually early on starts to see a decline in performance, but you're reshuffling the deck to actually allow you to propel forward. A lot of different terms for it, hockey stick, whatever you want to call it, right? But yeah, I think that's
Rob,
a lot of what we're seeing here too.
there's also a question over how bad it will really be. So everybody's saying, "Oh, tariff is a tax; it's going to lead to disaster." I was I was speaking at a conference last week, discussing ideas. I was one of 4 speakers there, and people sort of they give this. Well, of course, this is the worst trade policy of all time. Of course, this is idiotic, and the question is, will it really happen? And, in last week's 5 Things, we talked about this great article that Anthony Pompliano wrote. Again, he went to look at the data. He looked at previous situations where the US instituted tariffs and then there was an increase in domestic supply. And in most of these situations, the price index didn't change
Yeah.
all that much. And so, everybody's doing this. Well, of course, this is a disaster, but when people look at the data, it's not, of course. We may be taking some short-term pain, but these markets tend to find equilibrium much faster than people expect. And the correlations that people expect to see, as we talked about earlier in this episode in thing 1 and thing 2, that's not always what people think it is, right? You have to look at the data, and the data doesn't always support that.
Yep. Yep. Great stuff there, Gary. Awesome breaking that down. Thing number 4, we're talking tech companies here. You've been hearing some complaining about supply chain disruption, tariffs, but what we continue to see and what we've been saying, and it's in the numbers if you ask me, the math is the math. AI just continues to pace, and it doesn't look like there's any slowing down there. Thing number 4, Gary, technology headwinds, yet AI spending resilience.
Yeah. So, Rob, obviously the macroeconomic situation and all of this talk about tariffs and a slowing economy, and earlier in this episode we talked about the IMF, the International Monetary Fund, reducing growth forecasts. None of those are good for the technology industry, particularly because those multi-trillion-dollar market cap companies have very high valuations, and the reason they have high valuations is because of high expected growth. Anything that reduces that forward growth rate by even a small amount will have a huge impact on the stock prices and the market indexes of these companies. So, we're seeing slowing growth, particularly in devices or physical things at companies like Apple and Tesla. And challenges with trade have caused difficulty for the industry. The one thing that does seem unaffected is AI, where AI related spending and capital expenditures continue to grow. And that's a huge contrast with the sales of physical product, which are suffering. And, I was taking a look over the weekend. Every large retailer that deals with physical product, companies like Best Buy, which sells physical technology, everybody's bringing down these estimates. And so, that's what we're starting to see. And yet, companies like Amazon, Microsoft, Meta, Alphabet have planned over $300 billion in AI spending for 2025. We've had months of DeepSeek related concerns that AI spending would slow, but there's no evidence of that so far.
Yeah, Gary, I think one of the things that you nailed was really what you're seeing is these AI tools or these agents, or even just the tools themselves being able to help employees become just more efficient, more creative, right? I think you're seeing huge investment return there. It's hard to realize that right now, but I think that's where these businesses are looking at. Okay, how can I get gains from these products in those certain areas? So there is a lot of talk about AI. Now it's like, okay, it's one thing to say what I just said. I mean, what are you seeing in terms of it being used? And what I'm saying is anything that really actually matters.
Yeah. So, as we were just talking about, we're seeing reduced device growth. DeepSeek scared everybody. Tariff concerns has the market jittery. And yet, the reason these companies are spending $300 billion this year on AI is because it's already helping some companies save money. And it's already gotten to the point where it's leaving people wondering if we're going to see higher unemployment, right? Are companies going to just use AI instead of hiring people? Or alternatively, there's a universe where we have more productive workers, right? If we have workers who are using AI and they're more productive, then it's easier to hire somebody who, wages aren't going to go up as much. If they can be more productive, then that's the kind of thing that companies would be interested in our view, given the implications for productivity, national security, cryptography, and of course, allowing FinX stars to make stylized photos of themselves. That's what everybody's been using AI for this month, right? We have probably, burned millions of dollars of energy just, having people making these stylized photos of themselves. But the big stuff, national security, cryptography, productivity, those trends have not shown any signs of slowing. I don't think anybody's cutting expenses this year.
Yeah, and I think Gary, it's too one thing from an investment standpoint as well. It's like when you are looking at a position, right? How is that company approaching AI? Are there particular ways in which AI could be deployed across that particular investment or business that you may be interested in? So that's a lot of stuff I've been looking at that has been curious for me. Is what are those intersections of what I'm seeing or have been seeing on the digital side, and then how it is affecting the areas you've talked about: productivity, manufacturing, national security, all sorts of different type of security procedures and protocols across businesses and industries. Great stuff. Gary, this is the, or not Gary, you know this. To everyone watching, this is the correlation issue, this week's version of Deep Knowledge Investing's 5 Things. We're about to wrap it up with our educational topic and educational thing. Before we do that, we'd love if you could give us thumbs up, thumbs down. If you give us thumbs down, please tell us why in the comments. And then also, if you consider subscribing to our channel and be sure to set those notifications to be turned on when new videos get posted, as well as head to our website, sign up for a free email subscription, and then use the Ask Gary feature. Send us a question. Gary will take a look, might end up making its way on the 5 thing, or especially if it's related to beginner, intermediate, investor education and advice, which brings us to our 5th thing. Today, we're talking about bond ratings and what those mean. Gary, thing number 5 to close out this week's correlation issue, our educational topic in understanding bond ratings. Why don't you first, Gary, give us the general information that we need to know about that?
Sure. So let's start with the real basics, Rob. Let's talk about what a bond is. And all a bond is it's debt. It's a promise to repay. So, if you buy a bond, you will give the government or a company, say, $1,000. And that company or the government says, okay, well, we will pay you interest on a certain schedule. at a certain interest rate. And then, when the bond matures, when we reach the end of its life, we will repay you your $1,000. Now, here's the question, Rob. You can look at, the US government, which may be borrowing, depending on, where on the yield curve they are, 3, 4, 5%, something like that. And then, you could look at, big corporates, which, like companies like IBM, where, they might pay, just a little bit more than the government. And everybody says, yeah, they'll be able to pay their bills. And then you look at some, corporate bonds from other companies that, maybe their business isn't as solid or isn't as secure. And so, you say, okay, well, we're going to pay more interest. And, there are some companies that are paying 8, 10, 12, 15% interest. Now, somebody might say, well, wait, why would I lend money to the US government if I'm only going to get 4 or 5% when I could lend money to this company and get 12% or 15%? And the answer is repayment risk, right? The government, they'll just print more dollars. You will get paid. There's a question over what those dollars will be worth, but they will repay you. But if you're dealing with a company where the interest rate, the yield to maturity is 12%, 15%, 10%, there's a reason they're charging more. And that's because you're taking the risk of not getting repaid. And so the question here is, how do you figure that out? And there are 3 rating agencies that do these kinds of bond evaluations. They're called Moody's, Standard and Poor's, and Fitch ratings. And so what they do is they review the bond issuer's financial situation and they assign a rating giving a general assessment of how likely the company is to repay bondholders. And again, if you look at the written version of the 5 things, what you'll see is Cash and put together a terrific chart showing all of the ratings. And so at the top are AAA ratings, prime ratings. It's like the US government. And then, high grade AA1 or AA plus.
Gary,
Yeah.
so with the agencies that you mentioned, Moody's, Standard and Poor's, the Fitch ratings, yeah, what are those grades that they use, and how do they kind of explain their credit evaluations that they give?
So the highest rating for all of them is AAA, right? Just AAA. And then, they each have their different nomenclature. Like Moody's will, under the AAA, they'll have AA1, AA2, AA3, and then A1, A2, A3. S&P and Fitch, they just make it a little more simple. They'll have AA plus, AA minus, A plus, A minus. At this point, you're familiar with it. Now, when we get down to the BAA3 or triple B minus or triple B minus for S&P and Fitch, that's the end of the investment grade credit. Speculative grade or junk bonds is everything below that. So BA1 or BB plus, everything there and below is, speculative grade junk bonds. You should be getting a very big interest rate premium to own these securities because there's a risk you may not be repaid.
Gary, what would you correlate? Like, what is exactly a bond rating? How should beginner, intermediate investors look at those when considering these bonds?
So the way to think about a bond rating is think about it like a credit score for companies, right? So, if you're watching this, chances are you have a credit score and you probably know what it is, right? Above 800, you're doing great. Above 700, you're in good shape. People in the 400, 500 range, those are, the equivalent of speculative grade or junk bond credit. It doesn't mean that you can't or won't pay your bills. It just means that the rating agencies are saying this is risky. And so they're looking at, a poor history or poor chance of repayment. And so that's the way that works.
Gary, when taking into account these bond ratings, right, and so what you're seeing, whether it be S&P, whatever chart, and how they may handle the bond ratings, I mean, what are some things that you need to take into account to give us a little bit more color and context around how these ratings get generated?
So the question here is, when you get a rating, is it accurate? And so going back to, thing number 3, when Cashin and I took a look at, the IMF's predictions, what we realized was, wow, the IMF is actually really good at making predictions on global growth. they nail these. And in general, the rating agencies tend to agree with each other. They tend to be fairly accurate, but there is a gigantic, a huge conflict of interest here. And the reason for that is because companies pay the rating agencies to rate them. So, if you're running a company, you would go to S&P or Fitch or Moody's and you say, I'm going to give you money. Could you, give my bonds a rating so that I can sell them in the market? And they say, yeah, sure, we'll take your money. Well, guess what? That gives them a gigantic incentive for great inflation, right? For everybody to get good ratings, because if people don't like their ratings, they won't want to pay you the next time. And where we had a disaster was that's part of what helped create the losses in the collateralized security collapse during the 2008 financial crisis. So, if you remember back to 2008, everybody heard about CMOs, collateralized mortgage obligations, or, CDOs, collateralized debt obligations. Those were all rated by the rating agencies. And it turns out that they had no idea what kind of risk was in there. I have no idea if they were incapable of evaluating the risk that they had in those securitizations, or if they just said, yeah, we can do it, but you're paying us. It'll probably be fine. Who cares? But, when they're wrong, they are really wrong, and everything was wrong all at once. So that's why looking at these correlations and looking at the incentives really matters. If you are paying somebody to give you a rating, chances are they're going to give you a good rating. So as a bond investor, right, the expression is caveat emptor, right? Let the buyer beware. If you are buying a bond because, well, Moody's or S&P or Fitch said, well, it's highly rated, we'll get paid back, that's not enough analysis. You can't use the rating agencies alone because they have a conflict of interest, right? You need to do more work if you're going to own corporate bonds.
Great stuff there, Gary. And yeah, it reminds me of one of my favorite movies, The Big Short. If you haven't seen it, it's a good one. It might be a little dramatized, but that's what we love about Hollywood. One of the few
Actually,
things.
Rob, there's a scene in there in that film, right, where they're talking about, selling securities and securitizations to people who are willing to buy at a certain price. And there was news out a week ago that some huge percentage of people are using buy now, pay later for their DoorDash
Right.
orders. Right. And so, like, FinX right now is full of people talking about, what the securitizations are. If somebody's buying a Chipotle burrito, like, would you rate it higher if they get guacamole on it? Right. I mean, it's kind of crazy, the idea that somebody could, but nobody's doing this, but the idea that somebody could potentially be securitizing your lunch.
Right. Yeah, it is a wild world. And then you even get into the stuff about micro lending and the whole area in that regard just moves quick. So but
And
anyways,
you
we'll
know
go
what?
down that rabbit hole another day. But
Wait,
Gary,
Rob, I'm gonna add one thing on this. Um, by the time we are at, securitizing micro lending or the guacamole on somebody's burrito, that's why earlier in this episode we're saying, like, a financialized economy, it works for me, but it will not work for the whole country.
right.
And this is why we're talking about the necessity of the country taking some pain and reshoring some
Yeah.
manufacturing, because we can't be in a position where all we do is
Yeah.
make burritos and then,
Right.
securitize that.
Right.
We need more than that here.
Yeah, it's such a great point, Gary. Such a great point. Thank you so much if you're still listening to this week's version of the Five Things, the Correlation Issue. As always, super grateful for you just tuning in, giving us a shot, and allowing us to present this information, keep you in tune with everything that's going on in the market. If you found this valuable, again, would love if you could please subscribe to our channel, share this channel with friends, give us some comments, feedback, head to our website, check out what we got going on over there. Gary, I will turn it over to you for the final words of this week's Five Things.
All right. Well, Rob, thanks so much to you and the team at Flying V. I know you've got to travel and you always make time for the five things. It's amazing. Really appreciate it. Great work also by Anton and Nazim. The guys there are doing a terrific job. Fantastic week by Cash and Crow, DKI intern from the University of Tennessee. He when he started with us, I thought, okay, great attitude, smart guy, but he's young, he's inexperienced, he's going to need a lot of training. Turns out he didn't need that much training. He's gotten up to speed really fast. As for everybody watching this, we know your time is valuable. Thank you so much for taking the time to spend it with us. If you want to like and subscribe, that would be great. But hey, we're not the boss of you. Do whatever you want. Either way, we will be back next week with a great issue, next great edition of the 5 Things, and we will see you next week.
Thanks, everyone.